Test 1, 2, 3. All right, good morning. Today being Wednesday, February 14, 2024, it is 8 a.m. and I'm calling the regular meeting of the Equity Public-Private Committee to order. The first order of business is procedures for teleconferencing.
Mr. Rue is supposed to be participating via Zoom. Let me see if he's on. I don't see him. So we can move with the agenda. He's not. I don't see him.
So we don't have a quorum, or do we?
So, we do not have a quorum. We only have, well, actually, we have Mr. Santos, me, and Mr. Jones. So we do have a quorum. And Mr. Rue just joined, so.
Okay, and then Mr. Gato is also present.
Yep.
Okay, so what about the procedures for teleconference? We don't need to go through
No,
that?
we don't.
Okay. So the next item on the agenda is approval of the minutes. I will entertain a motion. That will be for the meeting of November 8th, 2023.
You can. No, you don't need to. I just need a second. You made the motion, Mr. Santos. I need a second.
I'll second.
Okay.
Okay, it's been moved on second. Is there any corrections, changes, modifications that we need to make to the minutes? Hearing none. Linda, please,
Okay,
roll call, please.
Mr. Santos,
Yes.
Mr. Rue,
Yes.
Mr. Gatto,
Yes.
Miss Me,
Yes.
Mr. Sorry, I need to call on you. The motion passes unanimously. Thank you.
Thank you, Linda. And next item is public comment. Have we received any requests for public comment?
We have not.
Anybody who wishes to speak at this time, please step forward. Don't hear anyone. We're moving forward. Next item is section 5, non-consent items, subsection 8, growth functional category, investment guidelines update. That would be Mr. Wagner.
Ms. Del Bosque.
Mr. Wagner's team. How about
Yeah,
it?
there we go. Good morning, Chair Santos, members of the committee, and board trustees present. Today, we are discussing the recommendation to advance to the Board of Investments proposed modifications to the growth functional category investment guidelines for global and private equity. This item is before the committee as structure reviews and investment guideline modifications therein are approved by the Board of Investments. I will discuss this further in the presentation, but to provide further context, upon board approval to move to the delegated authority framework last year, staff highlighted that a series of documents and governing policies would be reviewed, which includes the proposed changes to asset class guidelines as needed to ensure consistency and harmonization of framework provisions. In December, the Real Assets team provided their committee with the recommended adjustments to their guidelines. Today, we are discussing growth, and there will be a series of updates for each functional category at subsequent committee meetings. Now, the proposed growth guideline modifications we are reviewing today are minimal, aimed at improving consistency, clarifying language, and to make slight adjustments to enhance the operations as well as the emerging manager program. Please note that attachments 2 and 3 of your packets include concurrence memos from consultants Makita and Stepstone as to the proposed guideline refinements. Moving to the presentation, I will start with more background for today's item in the growth category, and then my colleagues, Ronson Cadua and Didier Acevedo, will provide context on the recommended changes to the guidelines. Thank you, Cindy, for driving slides today. If we can start on slide 3, please.
I don't know if you could hear us. Let me see.
Okay. Thank you, Linda.
Just 1 second, the internet went out, so she's trying to, there you go.
Great. Slide 3, Cindy, if possible. Thank you. Wonderful. All right, here we present a timeline detailing the evolution of the portfolio at the portfolio structure level for the growth functional category. Since 2020, we have conducted 3 structure reviews. Today, we discuss proposed investment guideline refinements, and the next full biennial structure review is slated for the second quarter of 2024. Next slide. Slide 4 provides an overview of the delegated authority framework, and through the infinity loop, shows how the governance set by the board on the left, numbers 1 through 3, are translated into action by staff on the right of the page, numbers 4 through 6. It's worth spending some time discussing the first 3 items on the left of the slide, describing the board's authority in the framework as they emphasize the order of operations and how the total fund is administered and constructed. At the highest level, the first thing the board approves is the investment policy statement, which sets the governance, investment beliefs, roles and responsibilities, and strategy for managing the LACERA pension. The second item in the order is board review and approval of strategic asset allocation for the fund. A strategic asset allocation study is conducted every 3 to 5 years or as necessary. The board is currently in an asset allocation review cycle, where later today at the board meeting, Makita and Ju Perez will be presenting on capital market expectations. Now, through the strategic asset allocation process, the board determines investment allocations across different functional asset categories, as well as the underlying asset classes, their policy targets, and benchmarks. Last, highlighted in yellow, are asset class structure reviews. As an asset allocation for the fund is approved, each functional team conducts a structure review to address how to implement the strategic asset allocation for its own asset category. This includes a review of investment allocations, benchmark targets, and specific investment guidelines for each asset class. The BOI reviews and approves each asset category structure review, which is conducted every 2 years or more often as needed. And as mentioned in my opening remarks, we are discussing a subset of that activity, which is the investment guideline refinements today. Moving to the next slide, please. Here we address the role of the growth functional category as it relates to the total fund. Fundamentally, the role of growth is to be the primary driver of long-term performance for the total fund while managing risk through diversification of asset types. Focusing on the graph in the slide, which depicts an upward trend from left to right, showing that as risk increases, the expected return also increases, indicates that of LACERA's functional categories, growth investments are positioned towards the higher end of both risk and expected return for the total fund. Now, as established through the board-approved strategic asset allocation and memorialized in the investment policy statement, the growth portfolio currently includes 3 asset categories: global equity, private equity, and non-core real estate. However, non-core real estate is reviewed as part of the real estate structure review, so that is why today we're covering the investment guidelines for global and private equity only. The slide also further expands in terms of the definition of global equity and private equity in terms of their role, where global equity serves as the foundation for obtaining U.S. and non-U.S. public equity market return, or beta, and private equity's role is to deliver the highest performance within the portfolio over time with an acceptable level of risk. It aims to access equity opportunities not readily available or efficiently priced in the public markets. If we move to slide 6, we'll cover portfolio composition as of December 2023. On the left-hand side, we see the overall composition of the total fund, where growth represents 53% or $40 billion of the total fund. And on the right-hand side, we see the breakdown of growth assets, where global equity represents 34%, private equity 18%, and non-core real estate 2%. On the bottom of the page, we display actual allocations compared to policy targets, policy ranges, and performance benchmarks for each sub-asset class within growth, which again are defined and were approved by the board via the strategic asset allocation exercise. With that background, I will now pass the presentation over to Ron, who will cover the global equity investment guidelines.
Good morning, Chair Santos, members of the committee, and trustees. Before diving into the guidelines, I thought it might be beneficial to the committee to provide some background on how we arrived at these guidelines. The Internal Investment Committee for the Growth Functional Asset category met and reviewed the proposed guidelines to ensure a level of consistency across the growth portfolio. Makita, our general consultant, also reviewed and concurred to the changes. Move here on slide 8, in terms of format, across the presentation, we display two tables for the investment guidelines slide. The table shaded green on the top half of the slide shows the proposed changes. The table shaded blue at the bottom half shows the existing guidelines which are being modified. The complete set of guidelines, if proposed changes are approved, are in the appendix section of this presentation. At a high level, we suggest two minor guideline modifications as a means to, one, reflect the current composition of the global equity portfolio, and two, to introduce risk parameters around sector and manager diversification. For the first line, under sub-asset class allocation, the global equity portfolio consists of three sub-strategies: passive, factor-based, and active strategies. We utilize our passive allocation to obtain market beta. It replicates the policy benchmark, which is the MSCI ACWI IMI. Next, our factor-based strategies seek to add incremental return over our passive allocation with low tracking error. Last, active strategies seek alpha in less efficient segments of the market with low to moderate tracking error. For the sub-asset class allocation, we propose increasing our factor-based strategies from 15% to 20% and decreasing the allocation to active strategies from 25% to 20%.
Could you explain for everybody's benefit the definition? What's tracking error?
Tracking error explains the variation of excess returns for the manager relative to their benchmark. So in terms of there's a benchmark that consists of securities in which the manager tries to outperform. And every month there's a variation. So the tracking error is the standard deviation of all those returns over a longer term period.
And perhaps it should be for Mr. Fernandez. The Sharpe ratio, what's your definition of Sharpe ratio and how does that compare to tracking error? Oh, it should be for Makita, right? I'm sorry, apologize. Makita.
So the tracking error is just looking at the manager excess or lack of excess performance versus the underlying benchmark. The Sharpe ratio goes another step further and looks at the underlying volatility of that track record as well relative to a risk-free rate in the market. So it's basically, they're answering two questions differently. One, the first question is that manager outperforming the benchmark and doing so in a manner that's within expectations? So it's critical to monitor the level of expected tracking error. If a manager is taking too much risk, they may produce good results, but it could have a negative consequence later down the road. The Sharpe ratio then looks to answer, are you being efficient with the risk that the manager is taking?
Good, thank you. My humble suggestion is, because we have many new trustees here, that we define those very important terms in the document. And as you make the presentation, you should define it, at least for the next 6 months, perhaps even a year. Then once everybody feels more comfortable with the terminology, then we can just go back to that. That will be for Mr. Wagner. Please.
Noted.
Continue, please.
So these proposed changes reflect the current composition of the portfolio as equity markets have favored large U.S. stocks. Given that the majority of our factor exposure is in U.S. equities, the allocation has increased over time. Approving the proposed modification will bring the portfolio closer to the new target allocations. For line 2, sector industry, we are proposing to limit GIC sectors to plus or minus 5% relative to the policy benchmark, the ACWI-IMI index. GICS, which stands for Global Industry Classification Standards, is a methodology used by MSCI, our policy benchmark provider, to define the 11 economic sectors within the MSCI ACWI-IMI. This includes sectors such as consumer discretionary, information technology, energy, or materials. Last, for manager diversification, we propose restricting assets of a single manager within the active sub-asset category to a maximum of 10% of the global equity portfolio, excluding the Emerging Manager Program, or EMP. This leads us to investment guidelines for the Global Equity Emerging Manager Program covered on slide 9. Cindy, next slide, please.
Any questions so far? Colleagues? No? Okay.
So historically, the board has approved EMP guidelines through RFPs. Given the delegated authority framework, it is worth memorializing the guidelines. Starting at the top, regarding the benchmark, the EMP is measured against the MSCI ACWI-IMI, which is the same benchmark as the broad global equity portfolio. Second, investment size. The allocation to emerging managers is 0 to 10% of the global equity portfolio. Third, for manager diversification, LACERA is to represent no more than 40% of the separate account manager or emerging manager's firm assets. Next, the program parameters consist of emerging manager requirements for inclusion into the global EMP, and they focus on 4 key areas. 1, organization, which keys on characteristics such as assets under management, independent firm ownership, and age of the firm. Second, investment experience. Third, manager diversification. And last, reporting. In terms of definition, emerging managers are defined as majority employee-owned firms with less substantial assets under management and may lack a long-term track record.
Thank you for that. And also, who is the fund of funds that handles the Emerging Manager Program?
There are 2 of them. There's Leading Edge Investment Advisors and New Alpha Asset Management.
And they're both for public equity.
Yes.
Good. Thank you.
So we're on graduation for global equity. This signifies reclassifying an investment from LACERA's Emerging Manager Program to LACERA's primary global equity portfolio. And lastly, for graduation timeline, the target is graduation 3 to 7 years after initial investment. This is consistent with the graduation timeline across the growth portfolio and the majority of LACERA's EMP programs. I will now pass over the presentation to Didier, who will cover the private equity guidelines.
Any questions on public equity?
Sorry, go back to the slides that talk about slide 8. If you don't mind, I know you briefly go over the sub-assets class. Could you expand a little bit more what passive, factor-based, and active investment are, and then what's the intention of them, like in this portfolio? Thank you.
So the portfolio is allocated to 60% passive strategies, and passive strategies are designed to obtain market beta. So we have an index strategy, and it mimics the MSCI ACWI benchmark. So that benchmark has about almost 10,000 securities. So that strategy mimics the index. So there's little variation from the benchmark. So it tracks very closely to that. And that's the majority of the allocation. Second, we have factor-based strategies, which are about 15% of the portfolio. That's a current target. And factor-based strategies factors explain the majority of stock variation, the variation in performance between stocks. And these include factors such stock. These stock characteristics include factors such as value, size, momentum, yield. So what factor-based strategies do is that they're able to add incremental return at lower risk than active managers. And lastly is the active segment, which is a 25% target. For active strategies, they seek to add alpha above the index. So they're more differentiated than the index. They're more concentrated. In passive strategies, I mentioned that the strategy has almost the same securities as the benchmark. But for active strategies, they have less stocks, more selected. So there's higher variation of returns than the index, or as we talked about, tracking error. But in terms of sizing, active strategies are sized, the least in terms of most of the value add we expected from passive strategies and factor strategies. That's about 85%, and active strategies is 15%.
Mr. Phillips, you have anything to add?
Nope, I think he did a relatively good job explaining each of the different categories. The one thing I would just say, notably across those categories as well, that fee component's really important. Passive, you're essentially capturing the market return, and LACERA's costs are incredibly low there, so really essentially zero. Factor-based is a little bit of a hybrid that sits in between passive and active, where it's looking at quantitative drivers and factors to produce some alpha, and then active can really be further out the risk spectrum. Ideally, those managers are outperforming and recovering their somewhat higher fees, but they can also provide differentiated characteristics. Oftentimes, active management will tend to outperform in negative environments or when volatility picks up. So you like to have a balance of each of them just to address different market environments, but also the passive is critical in keeping fees low for your beneficiaries.
Thank you. Ms. B? You're satisfied with those answers?
Thank you both.
Great, thank you. Mr. Didier?
Good morning, Chair Santos and trustees. So the next 4 slides will cover the proposed private equity guideline updates. Just as a reminder, Stepstone, the board's private equity consultant, has reviewed the proposed guidelines and has provided a concurrence memo in this packet. But to take into account the feedback real time in terms of definitions and portfolio intentionality, if we just take a look at the very top box and look at the sub-asset class category, we'll break those up into 2 components. First is fund investments, which we call them primary investments. Those are investments that LACERA makes with a private equity manager. Typically, these are the ones that you receive in FYI memos in closed session. And then there is alternative investment structures, and so that includes separately managed accounts, fund of funds, co-investments, and secondaries. I'll start with fund of funds, which is easy to explain. It is a fund that is the underlying composition are private equity funds. This vehicle is commingled in nature, meaning there are multiple LPs, not just LACERA. The terms are not really that negotiable because it's already a prepackaged product. And so we then choose whether or not we want to be part of this fund-to-fund manager. That manager has discretion over all of the investments that are made into that vehicle. Similar but different is a separately managed account, which is a one-on-one relationship with LACERA. It allows us to drive terms to a degree. It allows us to also shape and cultivate the program in a way that is most conducive to our needs. And here's where you see sort of our emerging manager program. So you see JP Morgan and Hamilton Lane, the tranches of those capitals of those emerging manager programs have come through separately managed accounts. The last category on the alternative side is a co-investment / secondary, and I'll address one.
Let me stop you right there, Mr. Didier, excuse me. So how do we, I'm taking this opportunity because I want to make sure that my colleagues get enlightened here. So how do we, staff, monitor the fund of funds? What, do they have to seek approval from LACERA when they are going to invest in a particular portfolio company? Just explain briefly the process of how we monitor to make sure that the fund of funds manager complies with the guidelines that this board has set.
Great question, Chair Santos. So differentiating fund of funds versus separately managed account, my understanding is fund of funds don't have that level of compliance, where on a separately managed account, there are consent rights usually built in, which means as an investment is being considered to be part of LACERA's portfolio, the team will get notification and we'll see if it makes, if there are any issues that may cross boundaries, which we wouldn't want to invest. Secondly, there are monthly and semi-monthly conversations to discuss pipeline and potential managers making it into the pipeline. And then lastly, our program, all of those managers sit with direct relationships with LACERA. So we end up signing the legal documents with those managers to keep them within compliance. And they also have to sign a combination of LACERA side letter that is baked into the separate account manager's side letter. If that makes sense.
Thank you.
You're welcome. So moving on to co-invest. This is a situation where a manager will make an investment within a fund and have excess capacity to invest in a company. They will offer that to their limited partners like LACERA, and we have the opportunity to invest directly into the company, usually via an aggregator vehicle. The appealing part of these co-invests is that they're usually offered on a fee-free basis, so there's no management fee or carried interest, which helps performance over the long term. Secondaries, unlike primaries, are investments that already have a limited partner in them, whether they be a fund or a company, and they're being sold on the secondary market, much like you would contract a broker to sell your house. And so we can take a look at opportunities that are seasoned assets that already exist, whether they're a fund interest, a portfolio of interest, or in most cases, just an individual company that we're looking to purchase. We can make an investment directly through a secondary transaction, usually with a general partner. So let me pause there just on definitions before going into intentionality.
Yeah, any questions with that? I think it's important. And also do you have, I don't know, maybe Mr. Fernandez has that. I'm sure you have it. What's the returns of the co-investment up to today?
So our combined co-invest and secondaries program has a 22% net IRR.
Say that again?
22% net IRR.
22%, very important.
We've committed $1.6 billion since 2019. The board had approved the program in late 2018. And our team has committed to about 36 different investments. If you split those up though, however, the story is kind of like there's some newer investments and then there's older investments. And I think it's worth mentioning the older investments, like 2019 vintage of co-invest, the performance is a 20% net IRR and a 1.9x completely realized. So we've received our capital back. Our 2020 vintage year is a 2.3x and a 40% IRR, and we received half of our capital back. And within our first secondary transactions, our very first one has been realized at a 1.5x net. Our second one is 1.6x, and our third one is a 2.25x. So a healthy start to the program.
Thank you. Thank you for that.
So moving on to intentionality, if we can maybe go, I think it's slide 4, which has the efficient frontier. Slide 5, sorry, excuse me, thank you. Eventually. So if you take a look at that long tail growth, so global equities would sit right where that dot is. And if you can imagine it sort of taking up space from left to right on the risk return spectrum, then private equity / buyouts would kind of go next in terms of the amount of risk that the fund takes, followed by growth equity. And then finally, at the very far end is venture capital investments, which demonstrate the most amount of risk, but potentially the highest returns. So if we could just go back to slide 10. So from a sub-asset class, a buyout fund is our managers will make investments in companies and take control, usually by investing more than 50% of the equity of the capital structure, and by having representation of board members that are the majority of the board of directors. This way they can effectuate change or drive any of the control that they want of these private companies. The buyout sector is kind of broken up into 4 categories for LACERA. Small buyout, which are micro-sized companies, middle market buyouts, which is kind of like the largest area of private equity, large buyout, which comprises companies that are around 3 billion in size and a little bit greater, and then global buyouts, which are, if you think of the mega managers that are public that are always in the news, those are kind of the ones that are global buyout. There are no proposed changes for the sub-asset class, so we'll just move over to venture capital and growth equity. Venture capital is also a private investment, and it spans sort of three categories. There's the very early stage, there's seed and Series A. And so if you think about that, that's your traditional startup. You think of, two co-founders, a laptop, maybe a company dog, and an idea. But once they move beyond Series A, there's this concept of product market fit. There's like a couple customers that are generating a lot of revenues for this company. And as you move further down the spectrum, and it's alphabetized, so B, C, D, E, and F. Once you start getting further down the alphabet, it becomes late stage venture, and these companies are much larger. So like an example of a very late stage venture or growth equity company is SpaceX, which has several $100 billion market cap, but still private, and it's still growing pretty rapidly and also deploying cash flows. So one of the characteristics of growth equity is that these companies may or may not be cash flow break even because they're reinvesting heavily to continue growing the company to grow rapidly. Within this area of high risk and high return, we're making the proposed changes of changing the allocation from 15 to 30% to 5 to 25%. And this is really a reflection of sort of the market opportunity. Late stage venture has pulled back significantly, and we've focused since on early stage venture, which tend to be smaller funds with smaller allocations and smaller companies that can deliver much larger returns potentially. So that covers the primary strategies. Should I pause here and see if there's any?
Yes. Any questions?
Quick question. So for both buyout, venture capital, growth equity, assuming there's a general partner, we are being a limited partner, right?
Could you repeat the question, please?
For the both category, buyouts and venture capital, growth equity, the two category, we are being the limited partner, invest along with general partner, correct?
In all of these, we're a limited partner, but the most traditional relationship of LP GP, you're right, vis-a-vis a fund are these two.
Okay, so we're not doing it alone.
No, we're not doing any of these alone.
Thank you.
Yeah, and just to follow up on that, could you define limited partner, what rights do we have, and how, in that framework, how do we monitor the portfolio?
Sure. So the reason why there is a limited partner and a general partner is the general partner takes on the majority of the risk of operations. If anything were to happen at the company, there's recourse that goes through to the general partner. Limited partners, their recourse is usually limited and negotiated to the amount of capital that has been put into the fund, but no greater. So LACERA is not at risk, for example, if a company gets sued and the amount of the lawsuit is greater than the value that we've put into the fund. That's typically how it's negotiated for limited partner rights. In exchange for that, we don't have any control over any of the companies. We don't sit on their board of directors. We don't tell the limited partners when to enter and when to exit companies. We tell them how to, if we're an advisory committee, we tell them specifically related to the fund structure, the items we would like to see and the governance of the fund, but we don't tell the limited partner which investments to make. We don't have consent right over the limited partners, general partners, investments.
So, Mr. Fernandez, you're a lawyer and you're our consultant for private equity. What happens if we are investors in a particular fund and we go beyond limited rights as limited partners? What will happen in that situation?
Yeah, good morning, Chair Santos. Good morning, Board. You have to be careful not to go beyond your enumerated rights within the limited partnership agreement, or you risk you put at risk your limited liability, and it becomes unlimited liability, just like a general partner. So if you go, if as stated by Didier, if you tell the general partner you need to exit this company, and you get involved in the operations of the fund, you put your limited liability at risk, and then you are potentially liable for more than the amount you committed to the fund.
Thank you. I think it's important because we're dealing in commingled funds, which it makes our ability to influence beyond the framework that we established is very serious and could subject the fund to greater liability. Anyway.
Thank you. So moving on to a proposed change is separating the fund of funds and separately managed account category from the co-investment and secondaries. And as we mentioned earlier, our co-investment and secondaries program, our in-house program, has grown quite a bit. And so we would like to have a defined allocation for those types of investments, and then separate out the types of investments that are either legacy fund of funds that we have and the ongoing emerging manager program. And so the allocations here are 0 to 15 for SMAs, as they're called, and then 5 to 35% for co-investments and secondaries. And just for context, the SMAs are 8% of NAV, net asset value, so the market value of the private equity portfolio, and co-investments and secondaries are currently 15%. So well within sort of the midpoint. From a geographical perspective, this is more of a clarification item, as is prohibited transaction types. Here, it just defines that emerging markets are in the international portion of the exposure for private equity. And emerging markets are categorized by rapidly growing countries or regions that are experiencing urbanization or people moving from rural areas into cities, greater infrastructure, and a rising middle class. The flip side of that is that they tend to be a little bit higher risk. There's political instability at times, and there's currency volatility, which have to be taken into account when making these types of investments. But no changes to the ranges. And then from the prohibited investment type, it's just under privatization. It defines per the IPS that it's privatization of jobs held by LACERA members. From an annual allocation perspective, I think it's worth providing context that in the 2022 structure review, the board approved us moving from a discretionary number for commitments every single year to a range based on the value of the total fund. So the range is 4 to 5% of the total funds commitments. If you think about that as December 31st, that's 4 to 5% of about $75 billion is what can be deployed in this coming year. So everything is going to be based off of that reference. And that takes us to our annual allocation change or proposed guideline change. So the first is that within primary investments, the collection of both buyout, venture capital / growth equity, the team can do up to 100% in buyouts in any given year, but there's no necessary, hard and fast rule that it has to be 100% or anything in between, anything below, which then provides room for separately managed accounts and co-invest. And for both of those categories, it's 30% of that annual budget, which we just referenced is 4 to 5% of the total fund assets. Okay. And then
You're good.
Okay, from an individual investment within those subcategories, there's concentration limits. So for example, there are no changes to the buyout and venture capital category, but within separately managed accounts, there was no limit before in terms of how large they could be. In this case, it's 70% of its annual budgeted amount, which is that 30% I just referenced. And then for co-invest, it's 25% of that annual budget amount, which again, it happens to be 30% in this case. So it covers the proposed guidelines changes on this slide. Before moving forward, just want to check, see if there's any.
Any questions?
Okay,
I don't see any.
great. So turning to the next slide, we discuss our emerging manager program. And as Ron articulated, the board had approved many of these guidelines vis-a-vis the RFPs. So every time a new RFP came within there would be guidelines and desirable attributes that we would like to see within the emerging manager program. They're being memorialized here given the changes in delegated authority. It's worth mentioning that the IPS has an attachment, which is called the emerging manager policy. Within there, it defines why we have emerging managers, period. And the reason is to drive better risk-adjusted returns. At $75 billion in size, our check sizes or our allocation to any individual investment is meaningful and very large. As a result, we've moved away from smaller investments. But those investments can generate risk-adjusted returns, albeit they have wide dispersion, like the best performing emerging manager and the worst performing emerging manager have a very wide performance gap. Whereas within our portfolio, that gap is a little bit smaller because they're more established. So we want to make sure that we're still connected to those managers and that we can see the potential next generation of those managers and see if they can get into our main program. And that's the reason why we have one of these within private equity. So just moving down the guideline list, I'll highlight the ones that are different from the main program or there's a little wrinkle. Like for example, in the sub-asset class, within venture capital, growth equity, and buyouts, it's all the same as the main program, but we've negotiated to not have co-investments or secondaries as we have an in-house team that executes those within this emerging manager program. The target allocation range specifically to EMPs is 10% of the PE NAV, and that's within the range of 0 to 15% for SMAs and fund of funds. In terms of manager diversification and concentration, the total commitments to any single partner can't be more than 20% of the SMA. So at least you'd have at least 5 managers if that were the case, but typically they're more diversified than 5 managers, sub-managers. From a fund concentration perspective, this is LACERA's share of the underlying manager can't be greater than 50%. So if it's a $50 million fund, LACERA can't be more than 25 million. The emerging manager definition within private equity is institutional funds 1 through 3 with assets less than $1 billion in buyout and growth equity and less than $400 million within venture capital. And lastly, there are some graduation targets and descriptions, but these managers tend to raise additional funds. If they were to become a graduate, they would have to go through our investment committee process, have a full underwrite, and then they would go into our main program. And 3 to 7 years allows for potentially two fund cycles to pass. So if they're in our emerging manager program as a fund 2, they most likely would raise fund 3, and potentially fund 4 could be one that we would look at.
And the cycle is how many years?
3 to 5 years.
Please.
So my question about EMP, the program is that we invest in smaller fund and manager that have less track record, right? So the wide range of skill set there. So what has been the performance for the programs compared with other investment?
Yeah, so there are four tranches of capital that are mature, previously managed. So the earliest one has a 19% IRR, followed by a 32% IRR, followed by a 12% and a 24% IRR. So on balance, they've been generating higher returns, albeit taking higher risk.
Thank you.
As a follow-up, do you know how we, by chance, compare to other funds' emerging managers program? Are we at the bell curve? Are we a standard deviation better? Or do you have any data on that?
In this case, trustee, but also Chair Jones. I don't have that answer, but we'll get back to you.
Just say if we're going to be best in class, let's be best in class in everything. Yep.
Okay. Thank you. So that concludes comments on this slide. If the committee is okay with moving forward.
Yes, please.
Okay. So it takes us to our co-investment and secondaries update. The majority of the changes here are to simplify the treatment of co-invest and secondaries. As mentioned on the first set of guideline changes that we proposed, it's changing from a dollar amount, which was $130 million for a maximum size of a co-invest or for a co-invest or secondary, to a maximum of 25% of the allocated amount to co-invest and or secondaries. The sourcing section has been simplified. There were 4 bullets across 2 categories, It eliminated redundancy and just kept them exactly the same. So we went from 4 bullets to 3 bullets. On a deal type perspective, we've proposed to add venture capital and growth equity, similar to what we do in primary. So if we were to be offered a co-invest in venture capital, we would be able to look at it, get it through our investment committees and see if it would pass muster and eventually potentially invest. And then lastly, it's cleaning up the investment limitations. This was more secondary language with respect to buying larger portfolios. If you take a look at 10% of LACERA's PE portfolio market value, that'd be about 1.3 billion. And it's far in excess of sort of that 20% limit that we're putting in for any secondary purchase. We just want to supersede that with, you know, a lower limit, if you will. So those are the updates on this page.
Good.
The last set of proposed guideline updates are to reflect the changes in delegated authority. So the only difference between the top and the bottom have to do with delegated authority. There are no changes to the parameters for a secondary sale, which is poor performance or the way that we would exit a manager early. Tail ends or managers that have gone beyond their maybe 10-year life and have 1 or 2 small orphan assets that we would like to clean up. Non-strategic, you know, relationships or assets that no longer fit the portfolio, whether style or manager related. And then lastly, a strategic sale, which is getting the portfolio to be right-sized and fit within its right parameters. So no changes there, but just wanted to go over those parameters.
Appreciate that. It's a TTR.
Okay, well, that covers both the glossary and the proposed guideline changes. So we asked that the board advance and propose and revise growth asset category guidelines.
Yes, sir, Mr. Gallo.
Thank you for an excellent presentation to all of you. This was very, very, very informative, and we appreciate it. One quick question is, did I hear you right that we're anticipating going into venture at some point, but we don't now? Is that correct?
So we have venture exposure through a couple of vehicles. One is through fund investments, where the GP is making all of the investments on behalf of LACERA. The second is through separately managed accounts and fund of funds, where the discretionary manager has put them in the fund construct. But in that situation that I mentioned earlier, where we typically get fee-free excess capital or excess allocation to invest in, we currently don't look at those opportunities. We only look at buyout and break-even sort of growth equity.
Okay, yeah, I thought I heard you say something about venturing into venture. Maybe I heard that wrong, but
it would be specific. So if you turn to slide 10, of the 4 asset categories here, it would be specific to the final one on the right-hand column that says co-investments and secondaries. It would allow the team to evaluate venture capital co-investments outside of a fund structure, but alongside a general partner.
And so 2 more questions. So when we currently invest, and you said we're investing in, for lack of a better word, a venture fund of funds, right? At the current time?
We invest both through a fund of funds. So for example, Hamilton Lane may have a venture fund that they have selected into the program they're in, but we also invest directly into venture funds.
Gotcha. Okay. Do you know off the top of your head what's the average number of different investments that these funds hold?
Separately so the SMAs hold, I believe, between 20 and 30.
The venture funds, and really our whole history in our emerging management program is with JP Morgan. They may be in each tranche, and we have 4 tranches, they maybe have done 3 or 4 venture funds, but the venture funds that they invest in and that LACERA invests in can hold anywhere from 30 to 50 companies.
Gotcha. Okay. And then last question is, venture, I believe, has a definition in terms of, I forget where in the alphabet soup it stops, but what is the average series that we're investing in? Is it B? Is it C, D?
So technically it can go on as far as the alphabet goes, but usually somewhere around D, E, and F in that area is where companies start to cross over into public market territory. Our portfolio had historically, and I'm talking 5 years ago, had more exposure to growth, later stage, which are bigger funds, allowing us to make bigger allocations. More recently, a decision was made in terms of valuations in the current environment to focus on the smaller end of venture capital. So for context, the last few recommendations that have come through for venture investments have been seed and Series A.
Wow. That's amazing. All right, thank you.
Any other questions? I have a couple. Mr. Grable, I suggest that the committees, the functional asset class committees, be reevaluated for efficiency. I think in the environment of discretionary authority, this presentation should be done directly to the board. It just doesn't make sense to me. We have this discussion. A couple of our colleagues are not here. And the board should be reviewing this. So for next agenda, let's have the discussion as to whether or not, and we invite the consultants to participate in that, as to whether or not the validity of these committees is still there. And again, my view is that it should be going directly to the board, but subject to be discussed next time. I got two questions for Mr. Fernandez. If you can tell us where are the valuations at entry level, and explain that to us. What does that mean, and why is that important? And also the dry powder in this particular industry.
So, entry-level valuations, that's for the managers, as explained, right? They're going to decide when to invest and what to invest in. And that implies at what valuation of the company that they're buying into, whether the whole company or part of the company, what the valuation is, right? And that's part of what you pay the management fees for, is for them to make the judgment of whether the valuation is a good valuation or not. It's obviously very different in venture than it is in buyout, because valuation in venture, when you have no, especially if there's no positive cash flows at the time, or they're not, they're, as the industry term, burning cash, which means that they are using more cash than they're generating as a business. That valuation becomes very much an art more than a science. It's really about what are the prospects of this company to eventually generate cash that exceeds the expenses, right? That's the venture managers do that, and they decide on how to do that. On the buyout area, these are more mature companies, and there is very much industry standards around valuations, and it depends on the industry, right? Valuations can be very high in the software sector, much lower in the manufacturing sector. So it depends on the industry. The important thing is, of course, that buy low, sell high. So you want that manager to buy at a good valuation so they can sell later at a higher valuation. That's a very surface explanation of valuation and of entry values, which was your question, right? Right. And of course, the managers, and that's what the team evaluates, does a lot of work to increase the valuation during their ownership period. And there's a lot of things they can do to influence that increase in value. You referred to dry powder. I don't have the statistics in front of me, but just a quick example, when you commit $100 million to a new partnership, then that manager has a period of 3 to 5 years to invest that capital, the $100 million. So on day one, the $100 million is what we call dry powder, because it's capital that the manager has committed, so they know they can invest it, and you as a limited partner will contribute it when they find the opportunities and they call the capital from you. As they invested, so let's say halfway through the 5-year period, they've invested half the capital, $50 million. So now they have 50 million of dry powder, not 100, because they've invested 50 million. As an industry, the buyout industry has billions of dollars of dry powder at the moment. Like I said, I don't have the exact number, but that is the amount of capital that they have available to invest into new opportunities. And it is, dry powder is at a record high as of year end 2023. There's different ways to look at that. I think it's got some positive implications, which means that there is a lot of capital available to invest. So the companies will be trading as the managers have the money to buy them. But it's, transaction volumes went down last year, which just given the economy, given interest rates were up, that puts some uncertainty around valuations. As interest rate changes, the valuation of companies change because the environment is different, the financing terms are different. And for that reason, we've had a long period of time, relatively long period of time, a couple of years of less transaction volume. But the dry powder is there. So we expect those transactions are going to pick up in the very near term.
So the bottom line is that our money will be competing with all the dry powder that is in the industry. And we rely heavily on the managers to make sure that, one, they buy low at the entry level and are able to responsibly invest our money.
Yeah, that's the key, right? Like, exactly. And look, that's what we always say, that, that's why you pay the management fees for, is for the managers to make that judgment. When is the time, when is the right valuation to invest, in addition to what they bring in terms of value creation after they invest. But that entry decision is really key. And yes, there is a lot of capital in the market that is competing for the opportunities that are available. So being partnered with the best managers in the business makes a big difference.
Critical. Thank you, Mr. Fernandez. Any questions on that?
No questions,
Nope.
but I have a comment.
Okay, please.
I know we're running out of time, but I want to make a quick comment. First thing is that thank you for the team. Good job on presentation. You answered a few of my questions already before I asked them. So thank you. The other thing is I want to echo what Chair Santos said about the committee. So my understanding is that we have a subcommittee for the intention of being efficient, right? When it was set up. However, the two major things have changed since that was set up. One is that we now have delegate authority, like Santos said, Mr. Santos. And then the other thing is that the big changes that on the board, we have a lot of new board trustee and with less knowledge, less experience in this. So in my opinion, when we subdivide it into small group of us in subcommittee, we have less wisdom, like compare a larger as a whole. So I'm thinking for important items like this, I agree that we should discuss as a whole on the board, and then I do agree that we should evaluate the committee again, not just efficiency but effectiveness. With the board, how we have it right now with new trustee, how effective is it the subcommittee are? And that's my comment. Thank you.
Thank you very much. Next item is.
We have to approve.
I will entertain a motion to approve the changes made, and these changes to be submitted to the full board for review and approval.
So real quick, I have some more questions on the venture aspects, but I have no problem moving this along today to the full board. Thanks.
Okay.
So I'll make the motion. Hopefully we can discuss it again at the full board, as is the wish, it sounds like, of my colleagues here, but I'll make the motion to move it along today.
I need a second.
I'll second.
Great. It's been moved and second. The staff understand that the board will like this matter to be reviewed by the board and ask follow-up questions. So I will suggest this will be placed on the action item rather than FYI. Roll call, please.
Mr. Santos?
Yes.
Mr. Rue?
Yes.
Mr. Gatto? Ms. B?
Yes.
Okay, the motion passes unanimously.
All right, thank you. Items for staff review.
Yes, we have the last item that was the board trustee Santos requested for the board, for the staff to review the effectiveness of the committees. And trustee Santos requested that investment terms be defined in presentations and board materials moving forward. That's it.
Great, thank you. Items of future agendas. Okay, that would be the review of the committee, yeah.
That goes on.
Go to the order. Mr. Chair, what time do you want to reconvene for the Board of Investments?
It's 9:01.
That's 9:01, it's 9:10.
All right, entertain a motion for adjourning this committee, and we will meet, the Board of Investments will meet at 9 a.m., 9:10 rather.